we are watching shares of Tesla this morning, the company announcing that it completed the sale of $5 billion in common stock on Friday. That was just in the span of about 3 days. It sold all of that stock. You can see this morning it's off by about 9.6%. In the meantime, the S&P Index Committee left this stock out of its index when announcing its coming quarterly rebalancing, surprising plenty of investors. Dan Ives is managing director at Wedbush Securities. And Dan, we want to talk about Tesla, but very quickly, just given the sell-off we're watching in technology shares once again this morning, why don't we talk more broadly about the stocks that are unraveling and unwinding right now? You were looking at 6.25% in declines just on Thursday and Friday. The NASDAQ futures were down as much as 3%, I saw earlier this morning. Do you worry broadly about those high flyers that all of them will come kind of crashing back down?
Yeah, look, it's a great question. I mean, to me, I view it as a natural speed bump or a process where we're still going higher. I still expect tech stocks 20 to 25% higher next 6 to 9 months, led by FAANG names. It comes down to the secular growth stories are transformational. I think some of the most that I've seen in 20 plus years covering tech in terms of cloud, EV, streaming, as well as when we look at a super cycle for Apple. So to me, I could tell you over the last, call it 2-3 days, over the weekend going to last week, institutionally, 2-to-1 ratio investors call me looking at names to own or do work on rather than selling. So I continue to view this as just a natural speed bump on our way higher.
So you would tell people to buy any of the FAANG stocks right now, given the sell-off that they've seen?
Well, to me, it's a green light. When I look at a name like Apple, I think that, base case 150, bull case 175 into what I view as a once-in-a-decade product cycle on iPhones. And we've just done checks even over the weekend in Asia, giving us further confidence and then an uptick in terms of demand. And then, of course, you look at other names. You look at names like an Amazon in terms of the cloud re-rating story. And obviously, Microsoft's one of our top picks there. Cloud, right now, we're only about a third of the way through the cloud shift, which is obviously accelerating this COVID pandemic. So to me, in terms of FAANG and tech, obviously a bit of white knuckles here, but we're not, our unwavering bull thesis here is fundamentally driven in terms of re-rating further in tech stocks.
Hey, Dan, just looking at this year, even with the sell-off that we're seeing, the NASDAQ's still up 26% year to date. And if you go all the way back to January 1st of 2017, you're talking about the NASDAQ up by 270%, whereas the broader market's up by about 55%. So you continue to believe that this is going to be the sector that outperforms, because that's some massive outperformance over the last 3 years.
Yeah, it's been massive outperformance, no doubt. And obviously, a lot of skeptics throughout the rally, but I view it as, if you look in this environment, a lot of these growth stories have been accelerated by 2 to 3 years in terms of what we're seeing today. Now, there's a digestion process in terms of the valuation, especially some of the work from home names and some of the large cap tech names. But to me, the fundamentals, I think Street's still underestimating where these stories go fundamentally. And I think it's a re-rating. It's a paradigm shift in terms of what we're seeing in tech stocks. And to me, as long as the fundamental drivers, and it's really been a two-phase. It's a recovery, in terms of first Rock of Gibraltar through this COVID environment. Now you have an economic recovery on the other side. So to me, tech stocks still go higher here, despite some of these movements, which I ultimately view as healthy.
Hey, Dan, we're out of time, but very quickly, would you buy Tesla shares here too?
Look, I would. S&P 500, in terms of the lack of inclusion on the index, that was a shock to the street. I think it's a knee-jerk. It continues to be the best way to play the EV market here, although the S&P 500 not being included was a shock to the bulls.